Hello everyone, my greetings to one and all. This is the last unit of macroeconomics titled Balance of Payment. In this unit, you will understand about the structure of balance of payment, the components of balance of payment, fixed exchange rate system, flexible exchange rate system, and managed floating exchange rate system. I am Poonam Vohra from Egypt Economics Learning Center, and this session focuses on the structure of balance of payment. So let us begin. A country's balance of payment is very relevant as it reveals the economic and financial status. It can be used as an indicator to determine whether there is currency appreciation or depreciation. Balance of payment statements also help the government to decide on its fiscal and its trade policies. It provides important information to analyze and understand the economic dealings of a country with other countries. So by studying balance of payment statement and its components closely, one would be able to identify trends that may be beneficial or harmful to the economy of the country and thus then take appropriate measures. Let us understand its meaning. Balance of payment is an accounting statement that provides a systematic record of all economic transactions between residents of a country and rest of the world in a given time period, where residents of a country include individuals, firms, and government agencies. However, residents do not include diplomatic staff, foreign military personnel, tourists, migratory workers, and branches of foreign companies, even though they work and operate within the domestic territory, where economic transactions refer to those transactions which involve transfer of ownership of goods, services, money, and assets. They are categorized as visible items, that is physical goods that are exported and imported, invisible items, that is all types of services like banking, insurance, etc. given and received, unilateral transfers, that is gifts, personal remittances, etc. and capital transfers, that is capital receipts through borrowings or sale of assets and through capital repayment or purchase of assets. Balance of payment is very significant for the economy. It shows export-import status of the country. If exports are greater than imports, the level of aggregate demand tends to rise. It implies growth potential of the economy. These accounts also reflect investment by the foreigners in the purchase of stocks and bonds in the domestic market, as higher investment implies healthy state of economy. Balance of payment account also show the extent of foreign direct investment, as increase in foreign direct investment implies GDP growth. Then international borrowings is an important component of balance of payment accounts, and in the context of India, it reflects our economic dependence on rest of the world. Since all foreign exchange transactions are routed through Reserve Bank of India, balance of payment account reflects the movement of foreign exchange reserves with RBI, because healthy reserves are a sign of healthy economy. Balance of payment accounts help the government to formulate a suitable strategy of growth in case growth process is disturbed due to high imports and low exports. Government can take steps to curb imports and increase exports. Briefly, balance of payment accounts shows the performance of the economy in relation to rest of the world. It also reflects the growth potential of the economy in terms of demand for the domestically produced goods and services in rest of the world. It also suggests the possible strategies of growth in terms of export promotion, import substitution, and investment from rest of the world. Let's have a look at the structure of balance of payment. It is a flow concept as it is related to a given period of time. It uses double entry book system, which has two sides, credit and debit. Credit side, all inflows of foreign exchange are recorded. Debit, all outflows of foreign exchange are recorded. Inflows comprise of exports, receipts from services, gifts, etc. And debit comprise of imports, payment made for services, gifts given, and so on. Balance of payment is in balance when receipts are equal to payments of foreign exchange. It is in surplus when receipts are greater than payments of foreign exchange, and in deficit when receipts are less than the payments of foreign exchange. Now assess yourself. You need to fill in the gaps with the correct option. 4 options are given. Import of machinery from France is recorded on the dash side of dash account of balance of payment. Option A, debit side and current account. B, debit side and capital account. C, credit side and capital account. And D, credit side and current account. Please check your answer. Import of machinery from France is recorded on the debit side of the current account of balance of payments. For import, payment has to be made, so debit. It's a current account because it's a good. It has nothing to do with liabilities or assets. So option A is correct. Let us understand the difference between balance of trade and balance of payment. Balance of trade is the difference between export and import of visible items. That is, exports minus imports, where exports are positive and credit item, imports are negative and debit item. It's a narrow concept and a part of balance of payment. Hence, unfavorable balance of trade can be met by favorable balance of payment. So far as balance of payment is concerned, it is a systematic record of economic transactions between residents of a country and rest of the world, and includes visible items, invisible items, unilateral and capital transfers. It is a wider concept and includes balance of trade. So unfavorable balance of payment cannot be met out of favorable balance of trade. Now have a look at this question and give the correct answer. Out of the 4 options given, loans taken from IMF are recorded on the dash side of dash account of balance of payment. Option A, credit side and current account. Option B, debit side and current account. Option C, credit side and capital account. And option D, debit side and capital account. Please check your answer. The correct answer is option C. Loans taken from IMF are recorded on the credit side of capital account of balance of payment. Please remember, loans are to be repaid and it affects the assets and liabilities. So, credit and capital account. I hope you have understood the structure of balance of payments. Please keep reading the newspapers and have an idea about the items that are imported or exported. This will give you a better understanding of this chapter. With this, the session comes to an end. Next session would be on components of balance of payments. Till then, keep reading and keep learning.